Good evening, everyone. Your week is going well. Tonight we're going to talk through Chapter 4, and it will take a while, probably a couple videos. And I'll be jumping back and forth between Microsoft Excel and the PowerPoint to give a little bit more insight on how to complete some of the calculations. And also just so you know, there was actually 102 slides in the PowerPoint, I believe, and I've got it down to 49 for the purposes of our video here. So hopefully it'll be insightful enough, but a little more concise. All right, so let's jump right in. So the topics we're going to be covering are time value topics: future value, present value, rate of return, amortization. We'll spend a lot of time on really future value and present value to start with. So the first way the book really shows you, and just gets an overview of this, showing a timeline of cash flows. And then, each one of these tick marks are time periods: year 1, year 2, year 3, your cash flow at the end of year 1, year 2, year 3, beginning, so forth and so on. So a timeline for a $100 lump sum due at the end of 2 years. This is what it would look like. Same thing, you have an ordinary annuity where the payments are made at the end of each year. So there's the end of year 1, 2, and 3. If you have uneven cash flows, here's what that would look like on a timeline. You invest $50, you receive $100 in year 2, you receive $75 in year 3, you receive $50. Again, these are really high levels, so I'm going to go pretty quickly through some of these. So now we're going to ask, hey, what is the future value? This one's more realistic and more applicable in my mind. So what's the future value if I invested $100 after 3 years and the interest rate is 10%? How can I figure that out? So the book walks you through, how to do that. Basically, the first way they're going to show you is using just a standard calculation, or longhand, as I would put it. So here that is, and I'm not going to walk you through every one of these calculations, but you got the future value after 1 year is equal to the present value plus the interest of 1 year. Very simple. What does it look like after 2 years, right? So you would then go through the same process, do the math, get year 2. And then lastly, you have to do the same thing for year 3. So there's also a standard general formula that you can use, using to the third power. Again, this is what I would call longhand. So there's 4 different ways, and they're saying 4 different ways to find future values, but I would say there's, most of the time, these same 4 ways are going to be present for a lot of these calculations. Not always, but for the most part. You have a step-by-step approach using a timeline. You can solve an equation with a regular calculator, or if you want to do the math in your head or on paper. You can also use a financial calculator, and the book and the PowerPoints have many examples where they're using the financial calculator. So if you're more comfortable with that, feel free to do that. And then the last one is using a spreadsheet or Excel. This is the one that I'm going to teach. This is the one that is going to be typically used in the real business world, and I'm sure many of you have used before. If you've never used Excel before, I would highly recommend just taking a beginner tutorial. There are plenty of free ones online or through Microsoft. So I would do that, and it should help you greatly in this class and beyond that. But that's how we're going to typically learn things in my class, because I not only want you to be able to do it easily and quickly, but I also want you to be able to use it in the real world. So let's look at the first one. So future value. How do we figure out future value? So here's where I'm going to bring in the Excel sheet. And ignore some of the other examples we'll get to in a minute. But future value example. So in the example, we had $100 that we were investing for 3 years. What's the future value of that? So you simply click in the cell and you say equals FV for future value, and it's going to give you the formula, and you can tab, and that'll put you inside the formula, as you can see here. And if you need some help with it, or you don't, if you haven't done it before, once you get inside that formula, I would go ahead and click this FX button, and then this is going to really walk you through.